Well, some former bank executives are heading back into financials in a new way. So-called blind pools are raising capital and picking up failed banks. One such new company is the $1.5 billion NBH Holdings. And joining me now is the president and CEO of FBR Capital Markets. That's Richard Hendrix. FBR has helped round up capital for NBH and is also investing in it. Rick, welcome. Thanks for coming on and talking to us about this phenomenon. So talk to us about exactly what blind pools are and why this might be a good way to approach some of these failed banks.
Well, blind pool is really referring to a style of transaction. NBH and any other group that would raise capital this way is really creating a corporate structure that ultimately would intend to be a bank holding company. The fact that it's referred to as a blind pool is simply referring to the fact that the capital that's being raised, while investors know what types of opportunities and investments the management team intends to make, they don't know the specific targets yet that NBH, in this case, might pursue from an acquisition standpoint.
But there is talk that they're looking at some of the failed banks that we have heard about nationwide. You also investing in NBH. Why do you think there are some opportunities with these failed banks?
Well, we're going to continue to see many more banks fail over the coming quarters and really coming years. And many of these banks have great core franchises, operate in locales that have real opportunity from an economic perspective. And as the government looks for new owners and new management teams for these banks, we think that great management paired with flexible capital will provide great investment opportunities going forward. The U.S. banking system has historically provided great returns to investors, and we think in appropriately structured transactions that will continue to be the case.
Well, with many of these banks, though, didn't they fail for a reason? I mean, in many cases, we saw loan losses go up, especially when you're talking about these smaller banks that have gone under. Can a new management team really save that, especially when the U.S. consumer is still hurting?
Well, the transactions that you referred to earlier as FDIC-assisted transactions are really set up to protect the new investors to some degree from the asset quality of the failed bank. So in many ways, this is a restart for these banks where there is some protection and insurance against the quality of the assets that the new management team's investing in. So new management with fresh capital really does provide a fresh start and provide a clean break from problems, particularly asset quality problems that the bank may have had and probably did have previously.
So, Rick, talk to us about where you see opportunity within the failed banks that we've heard about thus far, either geographically or maybe size or focus of these particular banks.
Well, there are banks across the country that are struggling and are on the FDIC list of troubled institutions. There are concentrations in a number of areas from a geographic perspective, the biggest ones being Florida and California. There are also, however, concentrations in the Midwest, in Illinois, and in Georgia. So the opportunities in terms of potential acquisition targets are extensive. And we believe that we're going to continue to see these government takeovers where there's a quick sale to new investors occur over the next 6-7 quarters.
Well, I guess what I'm asking is what qualities are you looking for in these failed banks that would make them particularly attractive?
Well, a great deposit base is number one. So the more core the deposit base is, the less the bank historically relied on CDs and what many people refer to as hot money deposits, really gets to the core strength of the franchise. From a size standpoint, we think there are still many banks that are larger than $2 billion in asset size that will fail, and you can begin to get even in local communities, economies, at those size ranges. So I think more than $2 billion and with a great core deposit franchise present great opportunities, and those are present across really the whole country with the concentrations that we talked about.
Rick, you mentioned that these companies, these blind pools that is, are going to have to become bank holding companies. That's what the sort of design is. Won't they then have to be certified, and how difficult is that process going to be?
Well, there are really a couple of different ways to go about becoming eligible to participate in the FDIC process. One would be to obtain a shelf charter, and that is, it's not easy, but with really high quality, well-known, well-regarded management and stable and diverse investors, we feel that that is something that's very achievable. The other way to do it would be to make an acquisition of a small bank and use that as your starting point to make acquisitions of additional institutions. There, again, you need to get approval for a change of control. So in either approach, you're going to have to obtain regulatory approval, which is why having a great, highly regarded management team is key to the success of any of these opportunities.
All right, Richard Hendrix, thanks a lot for coming on to talk to us about the situation. We'll probably keep monitoring it and check back in with him as some of these companies start making acquisitions.